Hello everyone, welcome to Tesla Daily News. Today is June 2nd, Tuesday, and the following is the latest Tesla news. According to market data, Tesla stock closed at $415.88, down from the previous close of $435.79. The shares opened at $427.49, traded between an intraday low of $415.43 and a high of $429.60, on heavy volume of about 44.6 million shares. In simple technical terms, sharp sell-off, strong volume, short-term downtrend pressure evident. For investors, this pullback likely reflects a mix of profit-taking after recent strength, persistent concerns over margins and demand in certain models, and a generally cautious risk sentiment in high-valuation tech and EV names. Traders will be watching whether the $415 area can act as short-term support, and whether the stock can recover toward the mid-430s in coming sessions. Longer-term shareholders may see this as normal volatility in a name that remains highly sensitive to both macro conditions and Tesla-specific headlines. Moving from the stock tape to the news flow, we now turn to the most important Tesla-related developments that could influence sentiment for both investors and enthusiasts. According to the West Australian News, Syrah Resources, a key graphite supplier, saw its shares surge after Tesla backed away from a move to terminate an important supply agreement. Syrah, backed by major Australian pension fund Australian Super, has been one of the more pressured critical minerals plays on the ASX, so Tesla's decision effectively granted the company a reprieve. For Tesla shareholders, this development is meaningful on several levels. First, it suggests Tesla is recommitting, at least for now, to this piece of its graphite supply chain, which helps reduce near-term uncertainty around raw material sourcing for battery production. Second, Tesla's retreat from terminating the deal may indicate that alternative graphite supply, especially outside China, is not as easily or cheaply replaceable as once hoped, underscoring the ongoing importance of strategic long-term offtake agreements. Third, for investors watching geopolitical and supply chain risk, the fact that Tesla is maintaining this relationship can be read as a signal that the company continues to diversify and secure upstream materials, which is critical to scaling energy storage and vehicle production in coming years. From Syrah's perspective, a reaffirmed Tesla contract stabilizes expectations for future revenue, improves financing prospects, and may support continued investment into production capacity. For Tesla, a resilient graphite pipeline can help protect gross margins from potential future price spikes. Altogether, this story reinforces how deeply Tesla is intertwined with the broader critical minerals ecosystem, and why supply chain headlines can move not just upstream miners but also shape perceptions of Tesla's long-term production and cost trajectory. According to Reuters, as reported by the Daily Telegraph in Australia, a detailed investigation into Tesla's full self-driving program has raised fresh safety and credibility concerns. The report cites 9 former data labellers and a former Tesla self-driving engineer, who say that FSD, even in recent months, has continued to struggle with basic driving maneuvers. These labellers spent their days reviewing real-world footage captured from Tesla vehicles running FSD, and what they described as unsettling. The former employees reported video evidence of FSD-equipped cars striking animals such as cats, dogs, and deer, as well as near misses with children playing in the street. 7 of the former data labellers and the former self-driving engineer said they personally would not trust Tesla's self-driving technology to drive them. One remarked, quote, "We have all seen it fail," while another said he would not ride in a Tesla robotaxi, quote, "If you ing pay me." The former self-driving engineer, who spent years reviewing Tesla crash data, went even further, calling the company's safety claims bull and adding, "Don't trust Elon on this." This investigation lands against a backdrop of bold public promises from Elon Musk. At a recent shareholders meeting, Musk said Tesla was close to a point where drivers could take their eyes off the road entirely. He even suggested Tesla might soon allow people to text and drive while FSD is active, calling that the killer app. He indicated that within a month or two Tesla would review safety statistics and then allow this behavior. Yet half a year later, Tesla has not formally approved texting while using FSD, highlighting a growing gap between public rhetoric and product reality. According to Reuters analysis, Tesla's oft-repeated claim that FSD is up to 10 times safer than a human driver rests on a questionable comparison. Tesla reportedly measures its crash rate using only incidents that are severe enough to trigger airbag deployment. It then compares that figure to federal crash statistics that are based on accidents where vehicles are damaged enough to require a tow truck. In other words, the underlying definitions of a crash are not aligned. Additionally, Tesla benchmarks its safety performance against the average US car on the road, which is much older than the typical Tesla. As Carnegie Mellon University engineering professor and autonomous vehicle safety expert Phil Koopman noted, any new car is dramatically safer than a vehicle that is more than a decade old, regardless of autonomy features. He likened the comparison to saying, "My jet airplane is faster than your World War II bomber," questioning what meaningful point such a comparison actually proves. Former Tesla employees also questioned how the company presents its robotaxi efforts. Before demonstration events, staff reportedly worked exceptionally long hours mapping specific routes and training the software on known local hazards to produce smooth-looking drives. In a pilot in Texas, some human safety monitors rode inside the cars while others watched remotely. The ex-employees argue that scaling up this level of hand-holding and route curation across entire cities or globally would be nearly impossible. Despite those internal doubts, Musk continues to assert that Tesla's self-driving will eventually operate globally using only cameras and AI, without technologies such as LiDAR, and that current owners will obtain full autonomy via over-the-air software updates. In Australia, for example, FSD is available on cars with the latest hardware, can handle many routine situations, but still requires continuous driver supervision and has shown weaknesses in complex environments. For investors, this investigation raises several key risks. On the regulatory side, if authorities conclude Tesla's safety comparisons are misleading, the company could face scrutiny, fines, or tighter restrictions on how it markets FSD. On the liability side, the gap between marketing language and actual system capabilities might expose Tesla to litigation risk in the event of serious accidents. On the brand side, repeated high-profile questions about FSD's real-world performance could slow adoption, reducing the high-margin software revenue Tesla hopes to extract from its installed base. Since the bullish long-term valuation case for Tesla often assumes substantial robotaxi and software income, anything that undermines those assumptions can have outsized effects on sentiment and valuation multiples. According to Goulburn Post News, Chinese automaker BYD has announced an aggressive new step in autonomous driving confidence. It will assume full liability for economic losses stemming from accidents that occur while its advanced driver assistance system, called God's Eye, is in charge under specific conditions. At its intelligence strategy launch event, BYD said that if an accident happens while a user is operating its Urban Navigate on autopilot feature in compliance with regulations, the company will directly cover all resulting economic losses. BYD framed this pledge as part of a broader, multi-billion-dollar initiative to invest heavily in advanced driver assistance and self-driving technology, including what it calls China's first mass-produced 4-nanometer autonomous driving chip. The company also said that its entire vehicle lineup can be equipped with a top-spec LiDAR version of God's Eye, enabling Level 3 and potentially Level 4 self-driving capability in the future. In China, customers can purchase a one-year plan tied to the use of God's Eye 5.0, which incorporates this liability coverage. BYD cites significant data to justify its confidence, more than 3.5 million vehicles equipped with intelligent driving assistance, accumulating around 2 million kilometers of driving data every day, and an R&D team of about 5,000 engineers focused on autonomy, which it claims is the largest in China's auto industry. The company has also introduced an AI-based hyper-realistic digital assistant for the cabin, promising a continuously evolving in-car experience as the system learns and updates. By contrast, Tesla's full self-driving supervised, which is available in markets like Australia, still places legal responsibility squarely on the driver. Tesla does not currently offer to cover all economic losses if FSD is in use and causes an accident. Instead, it emphasizes that FSD is a driver assist system that requires full attention and that drivers remain responsible at all times. For Tesla investors, BYD's move matters because it changes the competitive benchmark. BYD is not just competing on hardware or price, but now on perceived confidence in its autonomy stack and on the willingness to stand behind it financially. If regulators and consumers in China respond positively to an automaker assuming explicit liability, similar expectations could emerge in other markets. This could put pressure on Tesla either to tighten its own safety claims and disclosures, or to take on more liability risk if it wants to claim parity in safety confidence. That, in turn, has direct financial implications, potentially affecting insurance partnerships, warranty provisioning, and the economics of any future robotaxi services. According to Hungarian outlet HVG, Tesla has reclaimed the top spot as the world's largest seller of battery electric vehicles, overtaking Chinese rival BYD according to data from Counterpoint Research. In the first quarter of the year, Tesla's vehicle deliveries rose about 6% compared with the same period a year earlier. This lifted Tesla's global market share in battery electric vehicles to around 13%, surpassing BYD Auto's roughly 11% and Geely's approximately 10% share. This is a notable reversal from late last year, when BYD had pulled ahead. In the fourth quarter of the previous year, BYD's market share was around 15% while Tesla's was about 10%. Since then, according to Counterpoint, BYD's sales fell 25% in the latest quarter, and Geely's sales slipped about 4%, while Tesla managed growth despite intense price competition and macro headwinds. The report also notes that global sales of pure battery electric vehicles grew roughly 5% year-on-year in the quarter, while plug-in hybrids actually shrank about 5%. Among individual models, the Tesla Model Y remained the world's best-selling EV, followed by the Geely Galaxy Xingyuan, with the Tesla Model 3 also among the top sellers. HVG points out that Tesla's earlier slump and BYD's temporary leadership were partly linked to Elon Musk's political behavior, including very public support for hard-right figures and confrontational postings on social media. Some non-right-wing EV buyers reportedly chose other brands as a result. The latest data suggests that this boycott effect may be fading, or at least being outweighed by Tesla's product and price positioning. For investors, Tesla retaking the global EV crown is significant for several reasons. It bolsters the narrative that Tesla remains the benchmark pure EV brand globally, which helps support its valuation premium and bargaining power with suppliers. It also shows that Tesla can still grow unit volumes without depending solely on one geography, even as competition from Chinese brands intensifies. At the same time, the relatively modest overall growth rate in global BEV sales and the decline in plug-in hybrids highlight that the EV transition is entering a more mature, price-sensitive phase, where cost, differentiation, and software revenues become critical. According to New Bomb in Greece, financial disclosures related to SpaceX's preparations for a market listing reveal that Elon Musk's space company has effectively become a major internal customer of Tesla's Cybertruck at a time when broader market demand appears to be weakening. The documents indicate that SpaceX purchased Cybertrucks worth about $131 million last year. Depending on the mix of configurations, that spending translates into an estimated range of roughly 1,300 to 1,800 Cybertrucks. Analysts quoted in the report suggest that, given typical fleet purchasing behavior favoring more affordable trims, SpaceX likely acquired close to about 1,700 units. The data show that in the fourth quarter of 2025 alone, SpaceX registered 1,279 Cybertrucks, which amounted to more than 18% of all Cybertruck registrations in the United States during that period. Additionally, other Musk-controlled companies, including Xi, Neuralink, and the Boring Company, collectively bought another 60 Cybertrucks. These purchases coincide with a period when external demand for the futuristic pickup appears to have softened. Tesla sold 38,965 Cybertrucks in the US during 2024, enough to make it the best-selling electric pickup that year. But in 2025, sales dropped to 20,237 units, and in the first quarter of 2026, Tesla reportedly delivered only 3,519 Cybertrucks in the US. The disclosures also show that both SpaceX and Xi have become important customers for Tesla's Megapack grid-scale energy storage systems. In 2025 alone, purchases of Megapack units by these Musk companies reached about $506 million, underlining how Musk's corporate ecosystem is reinforcing Tesla's energy business as well as its automotive division. For Tesla investors, these related party transactions cut both ways. On the positive side, they provide meaningful incremental revenue and help support utilization of Cybertruck production capacity and Megapack manufacturing lines. They also demonstrate how Tesla's products can serve high-profile, technologically advanced customers like SpaceX, which can be a strong marketing narrative. On the other hand, reliance on internal demand raises questions about the true underlying strength of the Cybertruck franchise in the open market. If a sizable portion of deliveries is effectively being absorbed by Musk's own companies, investors must ask whether Cybertruck is meeting original expectations for mass-market adoption. Moreover, regulators and analysts will look closely at the pricing and terms of these transactions to ensure they are conducted at arm's length and do not artificially prop up Tesla's reported revenue or margins. Together, the Cybertruck and Megapack purchases illustrate a broader theme. The Musk corporate constellation is increasingly intertwined, with Tesla supplying vehicles and energy systems that enable other Musk companies' operations, while those sister companies, in turn, help stabilize Tesla's top line during periods of uneven external demand. According to Lithuanian outlet Reuters, LT, a U.S. Tesla owner's experience is drawing attention to the resale value dynamics of Tesla vehicles and EVs more broadly. A Reddit user reported paying around $65,000 in March of 2023 for a Tesla Model Y equipped with enhanced autopilot. After roughly 3 years from the vehicle's production and purchase timeframe, used car dealers were offering only about $25,000 for the car. The owner, with around 56,000 kilometers, or about 35,000 miles, on the odometer, and a history of careful home charging to preserve the battery, expressed shock at seeing more than a halving of value in such a short period. Market experts quoted in the piece, however, argue that this level of depreciation is a logical consequence of several factors. The mileage is in the medium to slightly higher range for 3 years, which weighs on residual value. More importantly, the EV market is evolving extremely quickly, with newer models offering better range, more efficient batteries, and more capable software, which makes earlier models feel dated more quickly than traditional combustion cars. The article also notes that traditional internal combustion vehicles still tend to hold their value more predictably on the secondary market, whereas many EVs, including Tesla models, are experiencing faster depreciation. Compounding the anxiety, the report references Reuters coverage showing that Tesla recently recalled more than 218,000 vehicles in the US due to an issue with delayed rear-view camera images, which could increase accident risk. The affected models include the core Tesla lineup, Model 3, Model Y, Model S, and Model X. Tesla is addressing the defect via an over-the-air software update. For Tesla shareholders, the depreciation story matters because it intersects with pricing strategy, customer satisfaction, and long-term brand strength. Aggressive price cuts on new Teslas, while supportive of volume growth and factory utilization, exert downward pressure on used values, which can lead to frustrated owners and potentially dampen repeat purchase intent. At the same time, fast-moving hardware and software innovation, while a competitive advantage in product capability, can make cars feel obsolete faster, again hurting residuals. From an investor's standpoint, these dynamics highlight the importance of monitoring Tesla's pricing discipline, lease residual assumptions, and the health of the certified pre-owned market. If depreciation remains steep, Tesla may need to offer stronger value propositions in software features, warranties, or trade-in programs to sustain customer loyalty, all of which have potential cost and margin implications. According to the Times of India, a new front is opening in the long-running rivalry between Elon Musk and Sam Altman, this time in the field of humanoid robotics. OpenAI CEO Sam Altman announced that OpenAI Robotics is now hiring engineers to build and manufacture robots intended to help people in the physical world. This move expands OpenAI beyond purely digital AI models and squarely into the physical robotics domain where Tesla is already developing its Optimus humanoid robot. In his post, Altman said that AI should be able to assist people in the real world, not just on screens. In the near term, the focus of OpenAI robotics will be robots that support skilled workers and help build future infrastructure. Over the longer run, Altman envisions a world where every person has a personal robot capable of doing almost anything they need. He noted that OpenAI's World Simulation Research Program, led by Aditya Ramesh, has evolved over the past year into OpenAI robotics, and that progress is rapid due to close co-design between hardware and machine learning research. For Tesla enthusiasts and investors, this matters because one of Tesla's most ambitious bets is on Optimus, the humanoid robot that Musk has said could eventually outnumber Tesla's cars and become a major driver of the company's value. The entry of OpenAI, armed with cutting-edge AI models and significant capital access, intensifies competition in that emerging market. It also raises questions about potential collaboration or conflict between Musk's XAI and Tesla on one side and OpenAI on the other, given Musk's past role as an OpenAI co-founder and his current lawsuit and public criticism of the company. In practical terms for investors, the humanoid robot race is still long dated, but it underscores a central point. Tesla's valuation increasingly reflects expectations not just around EVs and energy storage, but also around frontier technologies like autonomy and robotics. Each move by a major AI player into robotics will influence how markets handicap Tesla's chances of turning Optimus from concept into mass-produced, economically viable robots that can generate meaningful revenue and profit. Altogether, today's news paints a nuanced picture of Tesla's position. On one hand, the company has regained global EV leadership and maintains deep control over parts of its supply chain, while also benefiting from internal demand from other Musk companies. On the other hand, it faces increasing scrutiny on FSD safety and marketing, intensifying competition in autonomy and robotics, and complex questions around demand durability and residual value. Thank you for listening to Tesla Daily News. If you enjoyed this episode and want to stay on top of the latest developments in Tesla and the broader EV space, please subscribe and share this podcast with other Tesla investors and enthusiasts.